Welcome back. Trevor, just before the break, you were talking about the retirement compensation arrangement. Please continue and
Yes,
explain
not
what
a
that is.
television,
Yeah,
called an RCA.
RCA.
Uh, we did, a few hundred of them when I was with the actuarial firm, and I still use them in the course of planning for a variety of reasons. They're more there's more latitude in planning than there would be with a pension plan, and as I said, they don't create a pension adjustment. So if you had somebody, let's say, earning several $100,000, they own their own company, they're maybe a young tech person, they're better off from a pure tax perspective and from a pension perspective to use the RSP for their primary registered plan. But if they need further retirement savings and corporate deductions, in '86 the government introduced the retirement compensation arrangement rules. Now they're still used as a nasty remedy if you try to set up the wrong thing, but in essence it allows a company to fund a supplemental pension benefit. So Canadian pension rules or pension limits are woefully behind the United States and our principal European trading partners. So if we wanted to create that pension equalization, we use an RCA. And an RCA is a funded trust where half of the money is invested and the other half of the deposit is held in refundable tax with CRA and then paid back when withdrawals happen. The advantages of it is that there are no age 71 rules. So you can take it out in your 80s or your 60s. It's loss of office that triggers the ability to take the money out, and it's particularly useful for severances. So executive severance, where you want to try to avoid having that lump sum, or the real tangible use, and there's a lot of that going on right now, is pre-departure planning. People who don't intend to be in Canada for whatever reason,
Okay.
we take it out, collapse it, and they pay what's called Part 13 tax,
Yeah.
which is 15 to 25%. And if you structure things correctly, that's the end of it.
Okay.
Hence, the NHL players in Canada use them in a profligate fashion.
Makes sense. Makes sense. Trevor, so for those who are watching and thinking about setting up an IPP, where do they start?
Speak to your financial advisor, and they'll know to call usually an actuarial consulting firm. You want someone who will come out and meet with you and go through the analysis. They will prepare an illustration for you, but also know where it works. If you're, 28 years old, you shouldn't be talking about an IPP. There's
Mhm.
something else.
Yeah.
If you're 63 and you're thinking about trying to sell the business, you and the spouse have been on the books for a while, then you certainly want to look at one of these things. But sort of understand contextually in an objective fashion where you are in terms of the life cycle of your business, what your tax needs are, what your future tax needs are, and what does retirement like for you. Um,
Yeah, and I was going to say, Trevor, because the people who are involved in this, I mean, the advisor has to work with the actuary.
mhm.
Advisor is often used as a broad term. So would you say the advisor has to have certain qualifications and skills?
One would hope that they've done a few and they have some battlefield experience. Most don't because there's only 15,000.
Mm.
What you want to be able to do is hopefully the advisor is a good listener and knows to stand aside and certainly have their client's interest and ask the right questions. But try not to, the worst thing is where we used to have to try to train the advisor to go out and answer the questions that we had had 1,000 times.
Yeah.
Involve the actuary because most of them have field people who go in and help. And then often it's the actuary themselves who will go out into the field and answer those questions and liaison with the accountant. Lawyers are very rarely involved in these things. They're pretty, canned in terms of what the documentation looks like. But getting the accountant to understand, because you always look to your accountant as sort of this oracle of Delphi when it comes to tax, and the vast majority of them are not tax specialists. They have taken courses in this kind of stuff, but their knowledge of IPPs is usually limited to having attended a 2-hour seminar. So there's not a
Okay.
lot of battlefield experience.
Yeah. What are the numbers we're looking at? And because I assume a lot of people are going to say, "Oh, that's a deterrent," and there's
Sure.
considerations, right? There's benefits, and that might
Yeah.
outweigh the cost.
Usually, I would think they're probably about $1,500 a year to
Okay.
keep going. Now, remember, in provinces that have payroll taxes, so Ontario, most of them do, the contributions don't attract that payroll tax, so there's a savings. And your management fees, investment management fees, as are your actuarial and pension management fees, are fully deductible. So again, what's the corporate tax rate? So it does reduce. But yeah, there's a fee. It's more expensive than operating an RRSP. But in the right situation, I think it makes a lot of sense. Particularly, I mean, as I said, the entrepreneur who's 63 and we get them a $1.4 million deduction
Hmm.
on day one, the setup fees and the professional fees are minimal.